The Bank of Canada Governor Tiff Macklem says the lending rate, now at 2.25%, is at the right level to keep inflation close to the 2% target. For more on the economic outlook for the country, let's go to Frances Donald, chief economist at RBC. Thanks for joining us today.
Yeah, thanks for having me.
Okay, so the governor spoke about the structural adjustment for the Canadian economy. Should this be translated as sort of the new reality?
There are a lot of new realities, and they are playing out in real time. We know that businesses and households are still adjusting to the tariff shock. And frankly, we don't even know what tariffs will look like 3 months from now after we go through another CUSMA review, or even where they'll be next year. So the Canadian economy is indeed in a state of flux, but we know the direction it's heading into. And what the Bank of Canada told us today very clearly is that it probably isn't the right tool to help Canada through this structural adjustment. Yes, it can reduce some of that interest rate burden for some Canadians who are struggling, but it isn't going to help us reskill or retool the economy. It's not going to help diversify trade. And certainly, it's not very helpful in an economic shock where we have areas of very extreme pain, for example, southwestern Ontario, and other areas of the economy that are relatively unscathed. So big message for Canadians today is maybe look a little bit away from the Bank of Canada to be what we traditionally think of as the savior of all our economic woes. Focus a little bit more on that budget coming through on November 4th, which is better suited to target what's really hurting Canada and helping it through this massive structural adjustment.
Okay, so do you think a trade deal or a potential trade deal with the U.S. would provide some quick relief?
Well, we have a trade deal with the United States, and it's certainly many elements of that. So let's remember that there are pockets of this economy, steel and aluminum, as I said, southwestern Ontario, who need immediate relief now. We don't know what that tariff will look like, but we know that the government is probably the best suited to help them with that going forward. So I don't know if there's such thing as the trade deal, Morel. We're going to have discussions about Section 232. We're going to have discussions about what diversifying export looks like as a go forward. It's not binary. It's not like we're going to wake up one day and see, oh, we have a trade deal that solves all of it. It's going to come down to those details. And that's why this is such a complicated environment for many businesses to traverse. That's why uncertainty is very low in Canada. Is very high in Canada, and business confidence is low. And it's why a lot of households who know they may or may not be impacted by various details of this trade deal find it hard to make big decisions. So clarity, of course, will help. And I would say it's probably that clarity more than necessarily on aggregate, a trade deal or no trade deal, that's going to be most impactful going forward.
Okay. Do you feel, and taking from what the central bank had to say today, that we can recover what has been lost, or we need to, do you think, refocus on how we plan to recover?
Well, that depends on what you mean by what has been lost. Are we going to suddenly see a return to our prior automotive sector? Probably not. But are we capable of seeing an economy that accelerates, that actually maybe even improves upon productivity levels that it did before, with substantial investment in the right directions, a rediversification of trade? Sure, that's a potential. But whatever we're looking to recover probably has to come from where growth can move forward, that aggregate number. It's not going to be a return to where we were a year ago. And so using different types of policy to try to target the old economy, maybe not as helpful in the new economy moving forward. And that's why this is so complicated. You and I are talking about the economy, but there are segments of this economy that are not going to look like how they've looked in the past several years or several decades. And there are places that are relatively unscathed. So that regionalization and sector by sector focus is more important. It's not as simple as, are we going backwards or forwards? There are some places that are going to go in whole new directions that we couldn't even have conceptualized even 6 months ago.
Macklem says core inflation has been sticky, but believes inflationary pressures are easing. Do you see it the same way?
Well, it's challenging. Certainly some areas of inflation are easing. Headline inflation is coming down in Canada, but I think a lot of Canadians might say, well, wait a second, my cost of living is still very high relative to where it was 5 years ago. So in year-over-year terms, sure, prices are not rising as quickly as they were, but there's generally this ongoing confidence shock in Canada around inflation, and there's probably more concern about inflation rising more quickly on a go-forward basis. So central banks in Canada, and we also, of course, had a rate cut from the Federal Reserve Reserve in the United States today, probably being very cautious about maintaining inflation expectations around that 2% level. And even Macklem today talked about the importance of the credibility of the central bank around that inflation target, particularly in Canada, where we have a single mandate going forward. So they're going to be watching that very, very closely, as are Canadians in their day-to-day life. So far, we're within the range of acceptable year-over-year inflation, but there's a history now for Canadians. They've experienced one of the greatest affordability shocks of their entire lives, certainly an area that we're probably all more sensitive to than maybe we would have been 5-6 years ago.
Okay, so let's factor in immigration as well, which you expect to hear about in the upcoming budget. What's your outlook for the Canadian labor market next year?
Well, challenging. This labor market is really evolving. And one of the most interesting facts from the Bank of Canada today was they actually talked about how many jobs does Canada need to create just to keep the labor market stable. And they said only 5,000 jobs a year need to be created in Canada to keep this labor market at the level it's at. Now, we have a lot of folks on the sidelines who want to get soaked up, so we probably need more than 5,000 jobs now to get back towards a more reasonable level of unemployment in the country. But why do we need to create fewer jobs now than we did last year or the year before? Well, we just have fewer people that need to be employed in Canada as that population growth level gets closer and closer towards 0%. That's going to be very impactful for a range of data. On one hand, it's going to make us look like we're all consuming maybe a little bit less or growing that consumption by less, but that's just because we have fewer people in the metaphorical room than we did last year. We're also probably going to see per capita measures. You might remember that was a big deal a couple of years over the past few years, that the economy was getting bigger, but our individual slices were getting smaller. You might see a bit of a reversal of that going forward. That's more of a trick of the denominator, how many people are coming in or leaving the country than it has been before. So we just got to be cautious about how that change in the population impacts the aggregate. But coming back to the most important story, which is how are everyday Canadians feeling this economy? The population number is going to impact what they see when they turn onto a show like this one and we talk about retail sales or GDP. But when it comes to the day-to-day, probably a little bit less impactful than what we see in terms of general inflation coming through or job growth.
Frances Donald, I've got to leave it there. Thanks for joining us today.